My name is Jake. Welcome to the channel. In today's video, I want to talk about 5 stocks that you should own in your portfolio. If you're between the ages of 18 and let's say 55, I believe that you should own every single one of these companies in your portfolio. Now, it doesn't matter if you are heavily skewed towards investing into ETFs and index funds or even mutual funds, or you're just investing in individual companies. I believe if you're watching this video, you should have these companies in your portfolio, and I'm going to share why. All right, and in today's video, I'm going to talk about the 5 companies individually. I'm not going to go into the fundamentals of the individual company. I'm not going to go into their balance sheets and all that good stuff, but I'm going to talk very high level of why you should own these companies in your portfolio. As well as towards the end of the video, what I'm going to do is I'm going to compare if you were to invest into these 5 companies, or if you were just to invest into the S&P 500 through an ETF like the SPDR SPY, what would your return look like over 10, 20, and 30 years? So stick around for that. That's going to be really interesting. And then lastly, the last part of the video is I'm going to go back into M1 Finance, what we see here on our screen, and I'm going to show you what the historical performance would have looked like if you would have invested in these 5 companies, as well as how it can look like depending on where you're at, right? I said between the ages of 18 and 55, and how you could set up your target allocation and your allocation based off of your age while still investing into these 5 companies. And then lastly, I'm going to share where I have these in my portfolio, how they're allocated, and kind of share a little bit of what's going on in my life. As you know, those of you that follow the channel, I'm in my early 30s, and my time horizon, my investing time horizon is going to differ from somebody that's in their 50s or maybe somebody that's right out of college in their early 20s. And so I'm going to share what I do in my early 30s and see, okay, well, what would that look like if I were in my 20s, my 30s, or my 50s, for example. All right, the very first company on the list is going to be Coca-Cola. Now, it doesn't matter if you bought Coca-Cola 20 years ago or if you're buying it in 2020, I believe it deserves a spot on the list. I believe that Coca-Cola is a brand, is a company that everyone on planet Earth, it doesn't matter if you're in North America, you're in South Africa, or in the middle of Europe somewhere, I believe that everyone understands and recognizes and can associate with the Coca-Cola brand. And I think Warren Buffett says it best when talking about investing into Coca-Cola.
I like wonderful brands. You got to take care of them, but if you take care of a great brand, it's forever. And those are the businesses I like. We own 400 million shares of Coca-Cola stock, as you know. We've never sold a share, and I wouldn't think of selling a share.
The second stock on the list is going to be Disney. Now, it doesn't matter if you were born in the 70s, the 80s, or here in 2000, you recognize Disney. You may have grown up on Disney films, whether it be Aladdin, The Lion King, whether it was the original Lion King or the remastered version of The Lion King, you recognize Disney. And Disney is dominating the marketplace when it comes to entertainment, not only in the US, but across the globe. And it doesn't matter if you're going on a cruise or if you're going to the box, you're going to the movie theaters, Disney is dominating that space. And now, I know that there's going to be 1 or 2 people watching the video and are going to look up the dividend yield of Disney, and they're going to see, okay, well, Disney only has just over a 1% dividend yield. And I know that there's going to be 1 or 2 people out there watching this video are going to think, okay, well, that's dumb. I don't want to invest in a company that only pays a 1% dividend yield. And they're going to go invest in a company that pays a 12% dividend yield. And this might happen.
Enough! You are all of you beneath me. I am a god, you dull creature, and I will not be bullied by that.
All right. I love Disney. It's a dividend growth company. It's a company that I believe that every investor should hold in their portfolio, whether it pays a 1% dividend today or in the future they increase that and you increase your yield on cost. I still believe it belongs in your portfolio. And we'll talk about that here later in the video of how you can adjust that and why you should adjust it depending on where you're at in terms of your age. All right, the third stock on the list is going to be Microsoft. Now, I could go into detail about all the things that Microsoft does, whether it be from acquiring companies like LinkedIn, Skype, having other business units like Xbox, all those different things that Microsoft does. And I'm not going to do that in this video. What I want to focus on is brand recognition and the best global brands of previous years. When you look at Microsoft over the years, it has maintained that top 5, top 10 for the last 20 years. Microsoft back in 2000 was ranked the second most valuable brand in the world. And if you fast forward to 2019, Microsoft, yes, it's not number 2, but it's still in that top 5 in position number 4. Microsoft, we heard from Warren Buffett earlier that you got to take care of your brand. You got to take care of it. And if you do that, there's so much value in that. And that is why, for me, among many other things, that Microsoft deserves a spot on this list at stock number 3 that every dividend investor should own. The 4th stock is going to be Johnson & Johnson. Now, when I think of Johnson & Johnson, I think of diversification and track record. Now, as a consumer, we get exposed to consumer-facing brands that are part of the Johnson & Johnson group, but there are also many different things that Johnson & Johnson does that as a consumer we don't see. And that is the first reason of why Johnson & Johnson receives a spot on this list, is because of broad diversification. The second reason is track history. If you look at Johnson & Johnson's dividend growth history of 57 years of dividend growth, this makes Johnson & Johnson a dividend king. A dividend king is a company that has increased their dividend consecutively, increased it year over year for over 50 years. Johnson & Johnson, like Coca-Cola, has increased its dividend for 57 years in a row. And because of this, this is why Johnson & Johnson has a spot on this list. The 5th stock on this list is going to be Waste Management. As a dividend investor, I can't think of a more boring company than Waste Management. As a dividend growth investor, I absolutely love this. As the human population continues to grow, not only here in North America, but globally, more people equals more trash equals more dividends. And as a dividend growth investor, I love to see this. And that is why Waste Management takes spot number 5 on this list. All right, now what I want to do is I want to take a look at if I were to invest in these 5 companies, or if I were just to invest into the S&P 500 through an ETF, for example, through SPY, what would my return look like over 10, 20, or 30 years? And what I've done is I've broken down all the stats here. For example, the 10-year dividend compounding annual growth rate, the current dividend yield as making the video, the years of dividend growth, consecutive dividend growth, the payout ratio, the allocation percentage in SPY, for example, as well as the market value dollars in SPY. So if you take the 5 companies here and you average them out, you're going to get an average of just over 10% of the 10-year dividend compounded annual growth rate. You're going to get just under 2% of the current yield. The years of growth, this is pretty cool. You're going to get 31 years of consecutive growth. Payout ratio is going to be 45%. Payout ratio is really important. This is your risk factor, is how much the company is paying out in relation to their earnings, their revenue, what they're bringing in, and what they're paying to their shareholders, compared to, reinvesting the dividends through research and development, all that good stuff. And then this piece here, the allocation in SPY, this is really interesting because if you were to invest into these 5 companies, you would get exposure to them directly through SPY, 8% of the allocation in SPY. Really interesting. Microsoft actually has the highest percentage. And what does that actually mean? So let me share what that actually looks like. So if you go over here to ETF.com, you check out SPY. I'll show you here really quick. SPY, you can check out all the information here. You can see, okay, the assets under management. This is the largest ETF according to, based off of the assets under management. And if you go down here and you see, okay, well, if I were to just buy this ETF, what exposure am I getting, right? And so you can see here, okay, of the 500 companies, this is how it's allocated. 5% to Microsoft, and you can see, okay, the list goes on. And here you got Coca-Cola just at 82%, 0.82%, And if you scroll down, you can see, okay, a lot of these other companies, you're only getting really minimal exposure to these companies, right? If you were to invest into Campbell's Soup, yeah, you're getting exposure through it, but just very marginally. Okay, so that's what I mean here by the allocation percentage in SPY and the market value in SPY. Okay, so if you were to just look at SPY over the last 10 years, just under 10%, the current yield is 1.66%. Now this is fairly low because at the time of preparing the video, the market went up. This changes over time. The years of growth, just 10 years, and the payout ratio collectively just under 55%. Now, what I was curious was, okay, well, what would the performance look like over the next 10, 20, and 30 years? And here are a few assumptions. If you were to invest $10,000, an initial investment, $10,000, you would reinvest the dividends. The dividend yield would remain the same. Now, this is unlikely, but I'm not able to do it any other way for this purpose. And then the next one, the dividend growth rate would remain the same. Also unlikely, but for the video, we'll just keep it. And then if you're going to add monthly additional investments of $500, just $500, and the assumed growth rate of share price at 7.5%, and this is not factoring in inflation, what would your portfolio look like if you went with just these 5 companies, or if you just went with the Spider SPY? So with these assumptions, the yearly cash flow from the dividends, if we were look at the SPY, or if we would look at the 5 individual companies over the next 10, 20, and 30 years, this is what it would look like. So in 10 years with the SPY, with these assumptions, you would get in yearly cash flow just over $2,500. Your portfolio value would be over $130,000. With the 5 companies in M1 Finance, which we're going to see in a second, you would have just under $3,000 in yearly cash flow, and the portfolio value would just be up a little bit over $133,000. If you were to do this for 20 years in SPY, you'd have over $10,000 in yearly cash flow, and your portfolio value would be over $400,000. And if you were to do this with M1 Finance, you would have just about $13,000 in yearly cash flow, and your portfolio value would be up over $450,000. If you were to do this for 30 years with SPY, you would have just shy of $40,000 in yearly cash flow, and your portfolio value would be over $1.3 million. In M1 Finance, you would have over $50,000 in yearly cash flow and over $1.4 million. So this is pretty powerful stuff. Now, obviously, you're going to have to make this work for you. Now, $500 of, where you're adding monthly contributions to your portfolio, that is obviously going to fluctuate who you are, and it could also change as times in your life change. And I think it's important to understand, historical returns are no guarantee of future returns, but just looking at the assumptions, this is kind of what you're looking at. And I think it's important to also highlight these returns are going to differ. If we look at the last 10 years, we've been in a bull market. So this is more skewed towards hyper growth companies and sectors, which, the SPY, the S&P 500, kind of you get the entire market. The 5 companies here, they're also pretty, spread out among different sectors. All right, let's hop back over to M1 Finance, and let's take a look at, if you were just to invest into the SPY, what would your historical return look like? As you can see here on your screen, you would have just over 57% in your performance. This is not factoring in the reinvestment of dividends. And if you take a look down here, you can see, okay, the dividend yield, the expense ratio. So this is not bad. I mean, this is incredibly passive. All right, so 57% return over the last 5 years. If we take a look at the 5 companies, the 5 stocks that we were talking about in this video, and we look at the historical return of these companies, we would have had over the last 5 years a return of just over 111%. Right? And this is once again not factoring in the reinvestment of dividends. And so if we go down here and we take a look, okay, what is the current dividend yield? What is the expense ratio? So obviously with individual companies, you're not going to have an expense ratio. And as I have it set up here, this is allocated at equal weighting. So each company is weighted equally with CocaCola and the rest, everybody equally weighted at 20%. Now, this is what I meant with in the beginning of the video. Remember when I said, okay, this kind of portfolio or these 5 companies, I believe every individual dividend investor should own. And this is what I meant with that. So if you're in your early 20s or in your mid 50s, you can still take advantage with investing into these companies, but your allocation is going to be different. All right, let me show you what that would look like. So if you're in your 20s and you're not expected to retire for 10, 20, whatever amount of years, so let's say 10 plus years, you can get much more aggressive with your investments. Now, I want to hop back over to here for just a second. If we look at the 10-year dividend compounding annual growth rate of these companies, you can see that some companies are growing their dividend quicker than others. So if you're in your early 20s, you're going to want to skew this more in favor of companies that have maybe a lower starting yield, but they're growing their dividend exponentially faster. So for example, in this case, with Disney growing its dividend much quicker, maybe you want to up this up to maybe 30%. And Microsoft being in the same boat, you can bump that up to 30% as well. And then with Coca-Cola, maybe you could bring it down to maybe 10%. And then you can say, okay, Johnson & Johnson, I want it to be at 15, and Waste Management maybe at 15. These are just examples. This is not financial advice. This is just an example of how you could do that. And so let's take a look at the historical return of this investment and see what it would look like. Okay, so you're going to get a higher performance with this target allocation. And yes, you're going to get a lower starting dividend yield, but this dividend yield is going to be growing exponentially faster. Okay? Now let's do this on the reverse side. Let's say you're in your 50s and you want to still invest into these 5 companies, but how would your target allocation look? So if you were in your mid 50s, maybe you do, I don't know, let's say 5% into Disney. You could do 20% in Microsoft. You could do 25 into Johnson & Johnson. You could do 20 into, or let's say, I don't know, 30%. I didn't prep this before the video. I'm just doing this on the fly, everybody. And then you say, okay, well, Waste Management, let's have at 20%. Okay, this is just an example. And if you were to save this and see, okay, well, what are the numbers going to look like with this? Okay, all right, you're going to have 113% performance over the last 5 years, but you're going to have a higher starting dividend yield. Okay, and this is just 5 companies, right? And if you're in that situation where you're in your early 20s or in your late 50s, you're going to have other investments to supplement this. Okay, if you're in your 50s, these are not going to be the only holdings in your portfolio, right? So this is an example of how every dividend investor, everyone aged 18 to 55, for example, should have these 5 companies in their portfolio. All 5 of these companies you're going to find in my portfolio. And as I mentioned before, I don't believe that these are just the only 5 companies or investments that you should hold, and that's the end of it. But I believe that these 5 companies deserve a spot in your portfolio. Okay, and so in my portfolio, I take a little bit of an unconventional route, and I've shared this in previous videos, but I'm kind of a dividend nerd. I have just under 100 holdings. Some of these are ETFs, but the majority of them are individual companies, and I invest into Coca-Cola into my portfolio. And let me share exactly where I have Coca-Cola in my portfolio. For those of you that are new to the channel, I break it up by sector, and in my consumer staples sector is where I hold Coca-Cola. And Coca-Cola, among other companies, holds the highest target allocation in my portfolio, along with Pepsi, Procter & Gamble, and Walmart. And in my portfolio, my target allocation is set to 7%. And those of you that follow the channel, you know that I transferred over my portfolio from Robinhood, and that is why I have a higher actual percentage in Coca-Cola currently. It's because I transferred my portfolio. I've not invested into Coca-Cola since being in M1 Finance because it's been overweight in my portfolio. Okay, so this is where I have Coca-Cola in my portfolio in relation to other, you can take a look at other companies in the consumer staple sector, right? So we got Kellogg's, we got Hershey's, we got Hormel Foods, Costco, Colgate, and others, okay? And if we take a look at the next one in Disney, Disney is going to be in my consumer discretionary slice. And as I mentioned, I'm in my early 30s, and I want to have a higher target allocation in Disney because I'm not looking to retire tomorrow. So in my own portfolio, I have 30% allocated to Disney within this slice. Among other great companies, wonderful businesses like McDonald's, Nike, Target, and others. Okay? The next one is going to be Microsoft. And Microsoft I hold in my technology slice. And Microsoft I have it equally weighted with other companies like Apple, Intel, Texas Instruments, and Visa. All right, and so I don't have Microsoft weighted heavier, though I guess I could, but at the moment I have it equally weighted with the other technology companies in my technology slice. The next one is going to be waste management. Waste management is in my industrial slice. And in my industrial slice, I have all the companies in here fairly equally weighted. So for example, Boeing, Caterpillar, Deere & Company, Dover, Honeywell, a lot of these, they're either at 5 or at 4% target allocation. And at the moment, I have waste management in my slice here at a 5% target allocation. And then lastly, Johnson & Johnson. I have Johnson & Johnson in my healthcare slice. And in my healthcare slice, I have Johnson & Johnson weighted at 30%, the highest percentage here among other companies like AbbVie, Cardinal Health, Stryker, Pfizer, and others. So for me at the moment, I have it weighted at 30% in this slice. Alrighty, everybody, those were the 5 companies that I believe every dividend investor should own. Whether you're having the target allocation set equally, or you're going to have them spread out where you're investing only 5% into Disney or 5% into Coca-Cola. I believe that every dividend investor should own all 5 of these companies, in addition to whether they have other individual companies that they invest in, or index funds or ETFs, or even mutual funds or real estate. I believe these 5 companies belong in every dividend investor's portfolio. Do you agree with me? Do you disagree with me? I'd be curious to hear what your thoughts are. Are these companies in your portfolio? Are there others that you feel that deserve a spot on this list? Let me know in the comment section below. If you're new to the channel, I'd invite you to subscribe. I share videos like this every single week. My content is really centered around newer or beginner investors looking to grow passive income through dividend growth investing. I upload weekly videos, and I will catch everybody in the next video.